The stock market has been on a wild ride, and in 2024 and 2025, we have seen the S&P 500 hit record highs. But let's be honest, it's the stats, and it's starting to feel a bit crowded. Valuations are stretched, and the equity risk premium is now at a 20-year low. This means you aren't exactly being paid well for the risks you are taking in stocks. So, where do you put your money when the market feels shaky? We enter the safe haven. And whether you're looking at the global power of the US Treasuries or the incredible high-yield opportunities right here in Uganda, timing your bond investment is the difference between just saving and building wealth. Today we are breaking down the exact moments you should jump into the Treasury bills and bonds. First, let's clear the air. A Treasury bond is just a loan. You're lending the money to the government, be it the US or the government of Uganda. In return, they promise two things: periodic interest payments, called coupons, and your full original investment back at the end. In Uganda, they're managed by the Bank of Uganda. And if you give them 1 million shillings for a 10-year bond, they might pay you 150,000 shillings every single year for a decade, then hand you $1 million back. It's predictable, it's safe, and right now the returns are beating almost every savings account out there. It's the perfect time to buy. It all comes down to the interest rate cycle. The best time to buy long-term bonds like 10 or 20 years is when interest rates are high, but expected to fall. Why? Because you lock in today's high rates. If you grab a 20-year Uganda bond at an 18.5% yield today, and next year the rates drop to 15%, you're still sitting pretty on the 18.5%. The second thing is to watch the inflation. If prices rise faster than your bonds return, you're losing purchasing power. But if inflation is cooling down, as we are seeing in some global markets, those high fixed yields become incredibly valuable. The third thing is to watch the yield curve steepening. And experts are predicting that steepening curves for 2026 are more likely. So this is a fancy way of saying intermediate bonds, and that is 3 to 7 years, are in the sweet spot. They offer a great balance of high yield without the long-term duration risk of a 20-year bond. Let's talk specifics about the Ugandan market, because the numbers here are eye-popping. While the US Treasuries are fair value, Uganda is offering some of the highest trusted returns in the region. Its 2-year bonds are averaging between 15.75%. 10-year bonds are averaging 16.25%. 20-year bonds are up to 18.5%. Think about that. An 18.5% return on a government-backed investment. If you're saving for school fees or a land purchase or retirement, this is a game changer. Now, I know that you're thinking, is my money tied up? Yes, for the term of the bond it is. But remember, these pay interest every 6 months. You get a steady salary from your investment while your capital stays safe. And if you're worried about starting small, you can jump in for as low as 100,000 Uganda shillings. Treasury bills and bonds, which one should you choose? Go for Treasury bills. They're short term, 91 to 364 days. If you need your money back within a year, maybe it's an emergency fund or money for a business move next year, you buy them at a discount and get the full value at the end. Go for Treasury bonds, long term, 2 to 20 years, if you want passive income. If you want a check or something hitting your account every 6 months to cover your bills, then bonds are the way. Here's a pro tip for 2026. Researchers across the world suggest a 60-35-5 split. That's 60% in stocks, 35% in bonds, and 5% in cash, which might be different for Uganda's case. So if you're currently 100% in stocks or other investments, or just keeping cash in your mobile money wallet, then you are missing out on these high yields. The other question is it risk-free? Well, nothing is certainly 100%, but this is as close as it gets. The primary risk isn't the government disappearing. It's inflation and liquidity. If you need to sell your 20-year bond early, you have to find a buyer on the secondary market. If rates have gone up since you bought, you might have to sell at a discount. That's why we say only invest money you are comfortable leaving for a duration, or use the interest payout to stay liquid. Bottom line, and within the global economy facing uncertainty in 2026, bonds aren't just a boring investment anymore. They're a strategic powerhouse. Don't wait for stocks to crash or other investments to fail. Lock in these yields while they are high. If you found this helpful, hit the like button and subscribe for more wealth building tips. I'll see you in the next one.